Hello, everybody. Welcome to This Week in Housing. My name is Sarah Eggleston with John L. Scott, and I am here to deliver the most updated news about the real estate market in our area, and I'll touch a little bit on across our nation. I'm going to go ahead and jump right into it because I do have a lot of slides to cover today. Beginning of the month, we get a lot of information that we didn't have prior to this. So if I could just share the correct screen. And there we go. So, as I said, this is This Week in Housing. And it is Blue Friday, got my colors on, and I am looking forward to this coming Sunday. Last Monday, Seahawks did take away a win, and so that was exciting. And this upcoming Sunday at 1:05 p.m., they will take on New York. So go ahead and tune in, and happy Blue Friday. So in the news, just out, fewer Americans signed contracts to buy homes in October. This is something we would expect to see this time of year, just based on general real estate traffic. Generally, there tends to be more sales in the spring and summer and fewer in the fall and winter. This year has been very different than most years, but it is kind of following that same trend as far as fewer homes coming on the market this time of year. So the number of Americans signing contracts fell for the second consecutive month as the lack of available homes continues to stifle house hunters. I did think this was interesting. Thanks to a red hot summer, contract signings are still 20.2% ahead of where they were last year, after lagging in the spring due to the coronavirus pandemic. Contract signings are a barometer of finalized purchases over the next 2 months. So these are our leading indicators. A contract signing is a leading indicator of where those closed homes are going to be in a month or two. So, and as far as mortgage rates, last week we had a rate of 2.72 for the 30-year fixed. And if we flip forward to this week, we have reached our 14th record low of the year. So we are at 2.71. So things just keep ticking down. One moment. As my cat interrupts my broadcast once again. So just looking at the instant reaction to the mortgage rates, this is from the National Association of Realtors. It was another record low this week, but fixed rates are expected to tumble to the lowest levels in history, hovering around 3.0 to 3.1 for the next year. In contrast, mortgage rates varied from 6 to 11% in the 90s and 5 to 9% in the early 2000s. While these ultra-low mortgage rates boost home buying activity to a 14-year high, inventory continues to drop, reaching record lows. So if we look at mortgage rates over the past number of years, this goes back to 2016, and you can see how much lower we were than in 2016. Excuse me. So we are reaching record lows, but we've been at historical lows for quite a while, and the fact that we are still going down is kind of a mind-blowing. So if you happen to not have refinanced your mortgage yet, definitely get in there and do it. reach out to me if you have questions about who to talk to. So if we look at our local market activity for King County, 479 new listings, 714 pendings, and 781 sold. So if we look at that on our map, you can see our new listings just dropped off and our pendings are still, our pendings are actually higher than last week. So the amount of inventory that's on the market is dwindling, and we are already at record low inventories. And if we look at showing traffic across the nation, so this is North America, we are, so this year's pre-pandemic peak, we are down 31.8% since the pre-pandemic peak, but we're up 15.7% on showings from this time last year nationwide. And you can see this big dip here, and that was the Thanksgiving holiday. People weren't out looking at homes. They were home with their families, hopefully with their households, enjoying their time and not out shopping for houses. So from our chairman and CEO of John L. Scott, Lennox Scott, we have this is the Southeast King County housing update, although it was pretty similar for Southwest King County. During the winter months, we see more homes going under contract than we do new resale listings. This is true every year, but this year it has been so intensely true. I mean, we're already at really low inventory, and now we're getting fewer listings on the market. So the overall activity was down 51% compared to overall active listings in South King County were down 51% compared to 2019. But the overall number of homes that went under contract was higher. So this just shows how much more difficult it is for buyers this year than it was last year to find the right home and position yourself correctly to get there. But that's all due to these low interest rates and driving that buyer demand. But you can certainly see for our total activity, 82.5% of listings went pending in the first 30 days. And if anything over 75% is an extreme frenzy. Healthy would be at like 25% for a healthy, balanced market. And overall, we're at 0.4 months inventory, and that is another crazy low number. A healthy market is like 4 to 6 months of inventory. And we're at 0.4. So this number means if no new homes came on the market starting now, we would run out of homes in 0.4 of a month. So these are new resale listings, and you can see this year is in red, and the other lines follow a really similar pattern of having fewer listings come on at the beginning of the year, the majority coming on in the summer, and then fewer homes coming on the market as we head into the fall and winter. You can see this little dip here was definitely due to the coronavirus and people not wanting to sell their homes during the pandemic. And that has just created a huge shortage for buyers out there. And we have fallen back into the same pattern as we have been in previous years. So the inventory shortage will continue for at least another several months. So inventory and home prices this is basic supply and demand economics. And this goes back to 2010. And you can see there was a lot of inventory on the market back then, and not a lot of people could purchase homes. So the home prices were lower. And as the inventory has dwindled over the years, our home prices have definitely increased, and we are seeing that today. Our home prices are breaking records on the median home sales and all that. So the lack of inventory is really driving prices up. So in order to make homes more affordable, we need to get more inventory on the market. So I'm going to read you this quote. I did think this was an important thing to touch on. Such a frenzy of activity, reminiscent of 2006, raises questions about a bubble and the potential for a painful crash. The answer? There is no comparison. Back in 2006, dubious adjustable rate mortgages taxed many buyers' budgets. Some loans didn't even require income documentation. Today, buyers are taking out 30-year fixed rate mortgages. 14 years ago, there were 3.8 million homes listed for sale, and home builders were putting up about 2 million new units. Now inventory is only at about 1.5 million homes, and home builders are underproducing relative to historical averages. So I have heard a lot of people talking about fear, about the correlations between what's happening now and what was happening in 2006, 2007, as far as the housing market prices going up and up and up. And there, yeah, as this says, there's really no comparison. If you're curious about this, I can get into way more detail about this than I'm going to get into right here. But there are many factors that say that this is not the same thing as that happened in 2008. So if we actually expect home sales in 2021 to come in 7% above 2020 levels. And this is from Danielle Hale, the chief economist at Realtor.com. Following a more normal seasonal trend and building momentum through the spring and sustaining the pace in the second half of the year. While home sales are expected to lose momentum over the last months of 2020, the shallower than normal seasonal slowdown creates a higher base of activity leading into 2021 that is roughly maintained for the first half of the year. So they're saying there's a lot of pent-up demand, and that is certainly going to carry over into 2021. Home really means something different to people now than it did a year ago, and I don't really see that reverting back to our previous state of mind. So if we look at what we, excuse me, one moment. So if we look at what the expert economists are saying as far as 2021 forecasts or forecasts over the next 12 months, home prices are expected to increase anywhere from 1.9 to 5.9%, depending on who you're going to ask. But no one thinks that there is going to be a deflation in price over the next year. And I'll end with this one. Above all, the 2021 outlook hinges on the course of the coronavirus. Both the recent virus surge and the election make the government emergency relief more likely. Next year will also start to show whether two of the big pandemic shifts will endure, from services to goods, and from in-home office to, or from in-office to remote work. Even small shifts in these trends, if permanent, could cause big changes in how businesses hire, how job seekers search, where people live, and how much they can earn. So if you do have any questions, my phone number and email address are up on the screen, or you can message me on whatever platform you're watching this on. And it's also linked in the description below. But I hope you enjoyed this week's update of This Week in Housing. I think it was a bit of a long one, but there was a lot to cover, and I wanted to nail down the point about where we're headed in 2021, according to The Economist. So anyways, thank you so much for joining me. I will be back here next week, Friday at 3 p.m. for This Week in Housing. Have a wonderful week, and I will see you then.